$38 trillion. Let that number sit for a second. Not billion, not million, 38 trillion. And no, that's not a typo. Right now, the United States government owes more money than any empire in human history. More than the cost of every war it has ever fought combined. More than the total economic output of most of the planet. And here's the uncomfortable truth almost nobody wants to say clearly. That debt is never going to be paid back. At least not in the way most people think. Not through higher taxes. Not through spending cuts. Not through some miraculous burst of economic growth. What's happening instead is far more subtle. Far more sophisticated. And far more dangerous if you don't see it coming. Because the United States isn't preparing for default. It's executing something else entirely. A slow, calculated financial maneuver that looks like chaos from the outside, but functions as relief from the inside. Right now, the national debt is growing by roughly $70,000 every single second. Not per minute. Not per hour. Per second. By the time this sentence ends, hundreds of thousands of new dollars have been added to the tab. Interest payments alone have exploded. In just a few years, they've become one of the fastest growing federal expenses. We're no longer borrowing to invest. We're borrowing to pay interest on money we borrowed before. This kind of debt level historically appears during world-ending wars. But this time it arrived during peacetime. So the obvious question is, how is this sustainable? And the obvious answer, the one you'll hear on television, is that it isn't. That tough choices are coming. That responsibility will eventually return. But that answer is wrong. Because governments do not behave like households. They don't play by the same rules. And the United States, in particular, has access to tools no other nation on earth possesses. This isn't a story about collapse. And it's not a story about default. It's a story about how debt can be dissolved without ever being paid. A story about inflation quietly doing the work no politician wants their name attached to. About assets hidden in plain sight. About accounting tricks that can move hundreds of billions without printing a single visible dollar. And about why the cost of all this won't appear on any government balance sheet. Because it's being transferred directly to you. Most people think financial crises announce themselves with alarms and headlines. They don't. They arrive disguised as policy. As temporary measures. As nothing to worry about. And by the time they're obvious, the transfer has already happened. Welcome to Finance Archives. In this series, we're going to break down what's really happening beneath the surface of the American debt machine. Why the debt isn't being repaid, how it's being quietly eroded, and who ultimately absorbs the loss. This isn't conspiracy. It's arithmetic. And once you see it, you can't unsee it. In the next part, we'll start with the first illusion, the idea that governments solve debt the same way people do. They don't. And understanding why is the key to everything that follows. When people hear the word debt, they instinctively think in personal terms. You borrow money. You pay it back. And if you can't, you lose something. Your house. Your car. Your credit. That logic feels obvious. It feels universal. And it's completely wrong when applied to governments. Because governments, especially powerful ones, do not operate under the same constraints as households, companies, or even banks. If you fall too deep into debt, there's a limit. If a corporation does, investors flee. If a country without monetary power does, it collapses. But the United States plays a different game. Every time the debt conversation surfaces, we're offered the same three solutions. Raise taxes. Cut spending. Grow the economy. They sound responsible. They sound adult. They also don't work, not at this scale. Raising taxes enough to materially impact a $38 trillion debt would crush consumption, stall growth, and trigger political revolt. No administration survives that. Cutting spending? The largest expenses are politically untouchable. Social programs. Defense. Interest itself. You don't cut your way out of a compounding spiral, you accelerate it. And economic growth? Even strong growth can't outrun interest when the base number is this large. Growth helps. It does not save you. So if none of the textbook solutions are viable, why isn't anyone panicking? Because the real solution isn't discussed on the campaign trail. It doesn't require votes. It doesn't require legislation. And most people don't recognize it while it's happening. The secret is something called monetary sovereignty. The United States issues debt in its own currency. It controls that currency. It controls the system that clears it. And it controls the central bank that ultimately backstops the entire operation. That combination is the ultimate cheat code. When a country borrows in a currency it doesn't control, it's trapped. When it borrows in its own currency, the rules change entirely. Because repayment no longer means giving the money back in real terms. It means redefining what that money is worth. This is the part people struggle with emotionally. They imagine default as missed payments, as empty vaults, as public failure. But modern default doesn't look like collapse. It looks like stability. Bills still get paid. Markets stay open. Elections continue. The difference is hidden in purchasing power. What's happening now isn't a refusal to pay. It's a quiet adjustment of what paying means. And once you understand that, the rest of the strategy becomes disturbingly logical. Because if you control the currency, you don't need to eliminate debt. You just need to make it smaller in real terms. Slowly, continuously, and without ever calling it what it is. In the next part, we're going to examine the most powerful tool in that process. The one that does the heavy lifting every single day. It doesn't make headlines. It doesn't require speeches. And it transfers wealth with surgical precision. Inflation. Inflation is usually explained as an accident, a side effect, a policy mistake, a temporary imbalance that central banks swear they can control. That story is comforting. It's also misleading. Because inflation isn't just an economic phenomenon. It's a financial instrument. And for the world's largest debtor, it's the most reliable one ever created. Here's the simple version. When prices rise, money buys less. When money buys less, the real value of debt shrinks. If you owe $38 trillion and the currency loses value, you're effectively repaying that debt with cheaper units over time. Nothing explodes. Nothing defaults. Nothing officially breaks. The numbers stay the same. The reality changes. This is why inflation has been called the only tax that doesn't require legislation. No vote. No bill. No announcement. Just erosion. A few percentage points per year doesn't sound dramatic. But over time it's devastating. At 2% inflation, half the purchasing power of money disappears in about 35 years. At 4%, it happens in less than 20. And that's not theoretical. Every dollar sitting in a savings account. Every bond paying fixed interest. Every salary that doesn't adjust instantly. All of it is quietly discounted. For you, inflation feels like a crisis. For the government, it's a solution that compounds. Because while your cost of living rises, the debt stays nominally fixed. The interest gets paid. The bonds mature. And the burden shrinks in real terms year after year. This is why inflation is never truly defeated. It's managed, redirected. Allowed to run, a little hot. Not enough to cause panic. Just enough to do the job. And here's the part most people miss. Inflation doesn't need to be extreme to be effective. It just needs to be persistent. A steady loss of purchasing power over a decade can erase trillions in real debt without a single dramatic moment. No headline screaming default. No emergency summits. No global reset announcement. Just groceries that cost more. Rent that keeps climbing. And wages that never quite catch up. The debt problem fades. Your problem doesn't. This is the foundational layer of the strategy. But inflation alone isn't fast enough. At this scale, even 4 or 5% per year takes time. And time is the one thing compounding interest doesn't forgive. So inflation does the daily work. And something else handles the big, sudden jumps. Something that's been sitting in a vault for decades, deliberately ignored on paper. In the next part, we're going to open that vault and look at how a single line on a balance sheet could change everything. There's a place in Kentucky you've heard of your entire life. Fort Knox. It's become a symbol of wealth, of security, of something untouchable. What almost no one talks about isn't the gold itself. It's how that gold is valued. Inside those vaults sit thousands of tons of physical gold. The largest sovereign hoard on the planet. Yet on the government's books, that gold isn't priced anywhere near what it trades for in the real world. It's listed at $42 per ounce. Not 4,000. Not 3,000. 42. That number was set in the early 1970s. And it has never been updated. Not because of an oversight. Not because someone forgot. Because leaving it untouched creates something powerful. A gap. And that gap, the difference between the paper value and the real market value, is one of the largest unrecognized assets in modern finance. On paper, the gold is worth a few $1 billion. In reality, it's worth hundreds of billions, potentially over $1 trillion depending on market prices. And here's the key point. That value already exists. Revaluing it doesn't require borrowing money. It doesn't require raising taxes. It doesn't even require printing new currency in the traditional sense. It's an accounting recognition of reality. By adjusting a number on a balance sheet, the Treasury could instantly create massive liquidity, legally, cleanly, and without adding a single dollar to the official debt. So why hasn't it happened already? Because gold revaluation isn't politically neutral. The moment you do it, you're admitting something uncomfortable. That the currency has been debased. You're telling bondholders their assets buy less than they thought. You're signaling that the rules underpinning the global financial system are shifting. That's not a technical decision. It's a geopolitical one. And it's not unprecedented. In 1933, during the depths of the Great Depression, the United States faced a collapsing banking system and deflation spiraling out of control. President Franklin D. Roosevelt took a radical step. Private gold ownership was restricted. Gold was absorbed by the government. And then, quietly but decisively, the official price of gold was raised. Overnight, the dollar was devalued. The Treasury's balance sheet strengthened. Liquidity returned to the system. It was controversial. It was aggressive. And it worked. Today, the mechanics would look cleaner. No confiscation. No emergency radio addresses. Just spreadsheets, certificates, transfers between institutions. But the effect would be the same. A sudden, powerful reduction in the real burden of debt. Gold is the old tool. The one central banks trusted when money still had weight. But there's another asset now. One that didn't exist during Roosevelt's time. One governments spent years dismissing, right up until they realized they owned a lot of it. In the next part, we're going to talk about that asset. And why holding it instead of selling it changes everything. For more than a decade, governments treated cryptocurrency the same way. As a curiosity. As a threat. As something temporary that would eventually fade. They regulated it. They criticized it. They promised to control it. And every time they seized it from criminals, they did the same thing. They sold it. Fast. Quietly. As if holding it was somehow irresponsible. That has changed. Not loudly. Not with press conferences. But decisively. Instead of auctioning off confiscated crypto assets, the US government began doing something very different. It started keeping them. Bitcoin seized from criminal cases. From fraud investigations. From ransomware takedowns. Assets that cost the government nothing to acquire, now sitting in official wallets, no longer treated as junk to be liquidated, but as reserves to be held. That shift matters more than most people realize. Because it signals a complete reversal in philosophy. For years, crypto was framed as speculative, unstable, unserious. And for private investors, that criticism still largely applies. But governments don't need price stability the way individuals do. They don't face margin calls. They don't panic sell. They don't need liquidity tomorrow morning. What they need is asymmetric upside. Bitcoin has a fixed supply. It cannot be printed. It cannot be diluted. And in a world where every major currency is expanding its supply to manage debt, that scarcity becomes strategically valuable. The government doesn't need Bitcoin to replace the dollar. It doesn't need it to become day-to-day money. It only needs it to appreciate faster than the debt grows. Even modest appreciation turns a confiscated asset into a long-term fiscal offset. And here's the part that feels uncomfortable. When the government acquires an asset at near zero cost and holds it indefinitely, the risk profile changes completely. Volatility doesn't matter. Drawdowns don't matter. Time works in their favor. For individuals, buying crypto means exposure, timing risk, emotional pressure. For the state, it's a patient position, one that benefits directly from monetary expansion everywhere else. This is why the reserve isn't limited to a single asset. It's diversification without purchase. Optionality without leverage. And unlike gold, which requires a political decision to revalue, crypto doesn't need permission. The market does the work. This doesn't replace inflation. It doesn't replace gold. It complements them. Inflation erodes continuously. Gold provides a one-time adjustment. Crypto offers long-term upside in a world running out of fiscal room. But strategies don't exist in a vacuum. Every mechanism has consequences. And every benefit has a counterparty. In the next part, we're going to talk about who actually wins from this system. And who quietly pays for it without ever seeing a line item or a vote. Every financial system has beneficiaries. And it always has someone who pays the price. This one is no different. The biggest winner is obvious. The largest debtor on earth. The United States government. When inflation rises, its obligations shrink in real terms. When assets appreciate, its balance sheet strengthens. When currency weakens, its old debts become easier to service. No defaults. No missed payments. Just time and math doing the work. But for every winner there are losers. And they're not hidden. They're just fragmented. If you hold cash you lose. Every year your money buys less and no interest rate truly makes you whole. If you hold bonds, you lose. Fixed payments in a depreciating currency guarantee a real decline in value. If you earn a fixed or slowly adjusting income, you lose. Prices rise first. Wages follow later, if they follow at all. This is what a wealth transfer looks like in modern finance. Not a seizure. Not a crisis. A quiet rebalancing that favors debtors over savers. And there is no debtor larger than the government issuing the currency you are forced to save in. This is why the process feels invisible. No one sends you a bill labeled inflation tax. No one asks for consent. No one votes on whether your purchasing power should decline. It just does. And here's the cruel irony. Even if you understand what's happening, participating isn't simple. When the government holds gold priced at decades-old levels and revalues it upward, who captures the gain? They do. When the government acquires digital assets at zero acquisition cost and holds them indefinitely, who benefits from long-term appreciation? They do. Private individuals face timing risk, volatility risk, emotional risk. The state doesn't. The game isn't rigged through conspiracy. It's rigged through positioning, time horizons, and the ability to absorb volatility without consequence. This is why the system feels unfair even when it's operating exactly as designed. Because it is. And there's one more consequence people underestimate. Trust. Currencies don't collapse because numbers break. They collapse when confidence does. If foreign creditors realize they're being repaid in systematically weaker money, they demand higher yields, or they walk away. If investors stop believing that bonds preserve value, interest rates rise. If interest rates rise, debt servicing costs explode. That's when central banks step in. They buy the debt. They create the money. And the cycle feeds itself. This is not hypothetical. It's structural. And once it's in motion, it's very hard to stop. Which brings us to the final question. Is this a temporary phase? Or the beginning of something much larger? In the final part, we're going to step back from the mechanics and look at the big picture. The historical pattern this follows, where it leads, and why what you're witnessing now may be one of the most important financial transitions of the modern era. Every financial era ends the same way. Not with an announcement. Not with a countdown. But with denial. People assume this time is different. That the rules will somehow bend without breaking. That complexity equals safety. History disagrees. Empires don't fall because they run out of money. They fall because they run out of credible ways to manage it. Rome debased its coins. Spain drowned in New World gold. Britain financed 2 world wars and never fully recovered. The mechanism changes. The outcome doesn't. What you're watching now isn't a crisis in the traditional sense. It's a transition. The post-World War II financial architecture, built on trust in the dollar, endless demand for U.S. debt and stable purchasing power, is quietly being rewritten. Not torn down. Rewritten. Debt isn't being eliminated. It's being dissolved. Through inflation that never quite returns to target. Through assets revalued when it becomes politically unavoidable. Through currencies weakened just enough to relieve pressure without triggering panic. This is not chaos. It's controlled erosion. And it's happening because there is no alternative that works fast enough. Raising taxes won't close the gap. Cutting spending won't touch the core problem. Growth can't outrun compounding interest forever. So the system does what systems under stress always do. It shifts the burden. Quietly. Legally. Gradually. From institutions to individuals. From creditors to debtors. From savers to issuers. Most people won't notice in real time. They'll just feel that life keeps getting more expensive. That savings don't stretch as far. That something feels off even when markets look calm. By the time the pattern is obvious, it will already be normalized. And that's the most important thing to understand. This isn't about predicting collapse. It's about recognizing direction. The question isn't whether the debt will be paid back. It won't. The question is who absorbs the loss. And whether you see the transfer while it's still unfolding. Because once monetary reality changes, it never snaps back to the old version. It only moves forward. If you want to understand how global finance actually works, not the slogans, not the headlines, but the mechanisms beneath them, this is exactly what we document here. This is Finance Archives. And if you don't want to miss the next chapter of this transformation, make sure you're subscribed. Because history isn't waiting, and the archive is being written in real time.